Welcome to the Coin Bureau Weekly News Roundup. My name is Jessica.
And my name is Guy. Here are the top stories in crypto this week.
Dump and pump. BTC crashes because of spot Bitcoin ETF outflows before rallying in response to the Fed's hawkishness. Where is BTC headed next?
Ethereum under scrutiny. The SEC reportedly investigates the entities behind Ethereum while it delays its spot ETF applications. What does this mean for ETH?
Anti-crypto EU. European Union politicians pass a controversial bill restricting crypto payments shortly before MiCA's stablecoin laws will go into effect, why Europeans could soon lose access to certain altcoins.
Fed cuts incoming. The Federal Reserve makes it clear that it will stick to lowering interest rates, while the Central Bank of Switzerland delivers a surprise decrease. How will this impact crypto?
And a closer look at last week's top-performing cryptos and where they could be headed next.
All this and more in just a moment. Last week, BTC experienced extreme price volatility. First, it fell by double digits. This was believed to be due to all the outflows from Grayscale's spot Bitcoin ETF, which totaled almost $900 million. At the same time, the other spot Bitcoin ETFs saw some of their lowest inflows since launching. Two things to note here. The first is that the outflows from Grayscale's spot Bitcoin ETF could continue for the next week or so. This assumes that most of these outflows are coming from bankrupt crypto lender Genesis, which was authorized to liquidate $1.6 billion in GBTC back in February. The second thing to note is that even though the other spot Bitcoin ETFs saw some of their lowest inflows since launching, they have not experienced any significant outflows. This suggests that ETF investors haven't been fazed by the recent correction, which is a very good sign. If you watched our video about the recent crypto dip, you'll know that we predicted the subsequent recovery rally and even noted that the catalyst for it would likely be the Fed's press conference. You'll also know that we could yet see a bigger crash, but we'll come back to that in a second. Now, the reason why the Fed's press conference was so bullish was basically because Fed Chair Jerome Powell made it clear that the central bank isn't concerned about inflation. For context, the CPI and PPI had recently come in higher than expected, leading to concerns that the Fed would be more hawkish. When the Fed came out as even more dovish, it created the perfect catalyst for a rally in stocks and crypto. The catch is that crypto and stocks may have a harder time rallying in the absence of any additional bullish catalysts. This depends on whether passive investment flows resume in full force or remain muted. BTC's chart suggests that it could go in either direction. On the 4-hour chart, BTC is struggling to break out of the downward trend it's been in over the last 2 weeks. And on the daily chart, BTC is well below the Bollinger Band moving average, a key zone of support during the recent rally, now resistance. The weekly chart, though, is where things get spooky. BTC appears to be painting an evening star candlestick pattern. This pattern typically occurs at the end of an enormous uptrend, and it marks a reversal, i.e. a big downtrend. Not sure if you've noticed, but BTC has been in an enormous uptrend for months. What would be truly scary, however, would be if BTC continued to fall this week and then painted an evening star candlestick pattern on the monthly. Barring any black swans, though, this is very unlikely, as interest rates are coming down, flows are coming back, and liquidity continues to rise. Now, if you plan on trading any volatility we could see in the interim, then be sure to check out the Coin Bureau deals page. It's got trading fee discounts of up to 60%, and sign-up bonuses of up to $60,000 on the best crypto exchanges. These deals are only available for our viewers and they won't be around for long, so be sure to take advantage of them while they last using the link in the description. Now, besides the spot Bitcoin ETF outflows, the other catalyst that seems to have caused the crypto market to fall was the news that the SEC is investigating the Ethereum Foundation and other entities affiliated with Ethereum. Naturally, the SEC is looking for proof that ETH is a security. 3 things to note here. The first is that the SEC has not charged the Ethereum Foundation or any other Ethereum-affiliated entities. It's merely investigating at this stage. For all we know, this investigation could come away empty-handed, and given Ethereum's decentralization, there is a good chance that it will. The second thing to note, however, is that the risk of the SEC going after entities behind Ethereum seems to be real. Logically, they wouldn't launch an investigation if they believed there was zero chance of eventual success. What's frustrating is that it's not entirely clear what they're looking for. The third thing to note, meanwhile, is the most important, and that's that Gary Gensler isn't actually the person you need to be paying attention to here. Enforcement actions are overseen by the SEC's Director of Enforcement, Gurbir Grewal. Now, we'll be doing an in-depth video about all of this later this week. So, to make sure you don't miss it, subscribe to the channel and ping that notification bell. And while you're at it, smash that like button to give this video a boost. Now, the revelation that the SEC was probing entities in Ethereum's ecosystem had a predictable effect on ETH's price. It flash crashed to almost 3K before recovering, but is still looking weak compared to BTC. This can be clearly seen on the ETH BTC chart, which looks weak across all timeframes. ETH's 4-hour chart is looking a little more bullish, but the apparent recovery could just as easily be painting a massive bear flag. ETH is also very far below the Bollinger Band moving average on the daily, but it's being held by the strong zones of support around 3K from the previous crypto cycle. Meanwhile, ETH's weekly chart looks like a classic blow-off top, and its monthly chart is dangerously close to painting the evening star candlestick pattern I talked about earlier. Taken together, it paints a very bleak picture for ETH, but the fact that asset managers haven't withdrawn their ETF applications says it all. It stands to reason that BlackRock & Co. would have withdrawn their spot Ethereum ETF applications if they thought there was a real risk that the SEC would go after ETH. Not only did they not do this, but BlackRock actually launched a tokenized fund on Ethereum, underscoring how bullish it is on ETH. Moreover, the SEC decided to delay VanEck's spot Ethereum ETF application. Again, it stands to reason that the SEC would have rejected the ETF if it truly believed ETH was a security. Then again, the SEC could just be biding its time ahead of the final decision date in May before rejecting all applications. Whatever the case, the fact that the SEC's investigation hasn't materialized into anything meaningful thus far probably means that there's no immediate cause for concern. This is reflected in ETH's quick recovery after investors digested the news. With a bit of luck, it will start catching up in BTC terms too. And you can learn more about how Ethereum's been doing since the Denkun upgrade using the link in the description. Now, speaking of regulations, the EU has approved a law which would effectively ban crypto payments made from self-custodial wallets. That's because it requires all crypto payments from self-custodial wallets to involve KYC. This will add costs to merchants and discourage them from accepting crypto. One important thing to note here. Contrary to what you may have seen on social media, the EU's new law does not ban crypto transfers between wallets, nor does it ban crypto transfers between your personal wallet and crypto exchanges. This law specifically targets crypto payments made from wallets. Even so, if you watched any of our videos about the FATF, you'll know that the endgame of its so-called recommendations is to make it next to impossible to do anything in crypto without an intermediary by labeling all non-intermediated activities as high risk. Some would say this is a big step in that direction. On that note, there is no question that this law is anti-crypto. That's because the same law allows for cash payments of up to €3,000 to be made without KYC, but the limit for crypto is zero. If this law was truly neutral, the limit for crypto payments would likewise have been set at €3,000. The EU's anti-crypto stance is not surprising, though, given how concerned it seems to be about competitors to the euro. What is surprising is that this same law includes a total ban on all cash payments worth more than €10,000. For what it's worth, this ban seems to be limited to business settings. But back to the euro. Now, if you've been keeping up with our coverage of the digital euro, you'll know that the ECB is genuinely terrified that another currency, including the US dollar, could compete with the euro. This is why the ECB is developing a digital euro and why the EU is cracking down on stablecoins. In case you missed the memo, the EU will essentially ban all USD stablecoins on the 30th of June. This means that European users of crypto exchanges will lose access to USDT pairs. Now, this is a very big problem, considering that most cryptos trade against USDT, and not all crypto exchanges offer euro trading pairs. The even bigger problem, though, is that the cost of supporting euro trading pairs for smaller crypto projects may not be worth it. The consequence is that it could become harder for Europeans to access small-cap altcoins. With a bit of luck, a euro stablecoin will be approved, but apparently none have been yet. So this begs the question of what you can do if you're a European crypto investor or trader. Well, the short answer is that you should seriously consider reaching out to the crypto exchange you're using and asking if they plan on listing euro pairs for the altcoins that you hold or actively trade. If they don't, then you need to make sure that the altcoins you hold can still be traded somewhere else, such as a DEX, for example. Consider that you could be an altcoin millionaire, but if all your wealth is in an altcoin that you can't sell on an exchange because of EU restrictions, then it doesn't exactly count. Now, the silver lining to all this overreach is that time is still on your side. I'll repeat that the deadline for stablecoin delistings in the EU is the 30th of June. Between now and then, we're likely to see most exchanges provide euro trading pairs, and it's possible that a euro stablecoin will be approved by regulators. At the very least, you should get enough of a heads up from the exchange you're using to know how these regulations will affect your crypto portfolio. But I'll reiterate that reaching out to them first may be a good idea. The last thing you want is to be stuck with customer support when it's all going down. Now, realistically, the stablecoin delistings will only last until the EU has approved some euro stablecoins. Believe it or not, but this is something the EU wants. That's because euro stablecoins will be backed by European government debt, and this will make it possible to subsidize EU government spending. This is probably why there may never be a crackdown on Tether. USDT, having a market cap of more than $100 billion, means that over $100 billion of US government debt has been bought. In other words, crypto degens like you and me are unknowingly subsidizing the spending of the US government. Now, subsidizing spending is something the US desperately needs, given that it's projected to run at a $1.6 trillion deficit this year. In plain English, the US government is going to spend $1.6 trillion more than it collects in taxes. This means that it will need to issue $1.6 trillion of debt. Now, all of this government spending has had the convenient effect of keeping the economy afloat, while the Federal Reserve has been holding interest rates at multi-decade highs. For those unfamiliar, the Fed started raising interest rates back in 2022 in order to combat inflation, which has since subsided. Although inflation isn't coming down nearly as fast as some expected, it's coming down fast enough for the Fed to still feel comfortable lowering interest rates later this year, per the updated Summary of Economic Projections, or SEP. Specifically, 3 cuts are on the schedule between now and December. Now, it's believed that the Fed will either do these cuts in April, June, July, or December, because doing them in September or November would be perceived as a political move because of the upcoming US presidential election. And, funnily enough, the Treasury Department will simultaneously begin buying back some of its debt over the summer. Put simply, the money printer is about to turn back on in a big way in the United States. In other countries, meanwhile, they've already flicked the switch, most notably Switzerland, which announced a surprise rate cut last week. Apparently, this is not that surprising given that the Swiss like to front-run the EU. Still, it highlights the fact that central banks around the world are starting to switch from tightening to easing. This will result in a global increase in borrowing, which, combined with obscene levels of government spending, will set the stage for outrageous all-time highs in crypto and elsewhere. Now, the caveat is something I mentioned earlier, and that's the possibility that something somewhere in the financial system could break. This could be pension funds going under because of exposure to commercial real estate, or the Chinese economy imploding because of, well, real estate. Oddly, though, it seems that real estate prices never seem to go down, despite all the apparent crises that seem to be emerging around the world. If it makes you feel any better, housing prices tend to lag the most, meaning that if you make big gains in crypto, you could still be early to buying property. Not financial advice, of course. And with all that said, it's about time we looked at last week's top-performing cryptos. So, Jessica, take it away.
Thanks, Guy. Well, last week's top-performing cryptos were Ondo, Stacks, Toncoin, eCash, and Phantom. Starting with Ondo, its Ondo token appears to have pumped in response to the news that BlackRock had tokenized a fund on Ethereum. That's because Ondo is a DeFi protocol focused on real-world assets or RWAs. Many smaller RWA-related cryptos also seem to have pumped in response. As you can see, Ondo appears to be painting a bull flag on the daily chart. If it plays out, it could easily rise over $1 in the coming days. At that point, it would be in full-on price discovery mode, meaning it would be hard to know just how high it could go in the short term. Next up, we have Stacks, whose STX coin appears to have pumped in response to the hype around the upcoming Nakamoto upgrade, which is expected in late April. Now, if we understand correctly, it will significantly increase the scalability of Stacks, which is a de facto layer 2 on Bitcoin. As you can see, STX appears to be breaking out of a massive bull flag. If it plays out, STX could rise over $4 in the next few days or weeks. This wouldn't be surprising given that STX's price action is highly correlated to BTC, and BTC's price is likely to rise leading up to the halving, which is also in late April. Now, as for Toncoin, Ton appears to have pumped on the news that Ton community rewards will be increasing on the 1st of April. As you can see, Ton's price action appears to be playing out just as we expected in last week's analysis. When it comes to eCash, its XEC coin appears to have pumped in response to another exchange listing. The recent upgrade it underwent likely also contributed to the rally. As you can see, XEC also appears to be painting a bull flag on the weekly. If it plays out, XEC could pump by more than 40%. Just note that it faces a lot of resistance on the way up. Finally, we have Phantom, whose FTM coin appears to have pumped in response to the speculation around its upcoming Sonic upgrade, which will of course significantly increase Phantom's speed. Notably, the Sonic upgrade will replace Phantom's existing Opera blockchain implementation. It's a brand new chain. As you can see, FTM doesn't appear to be painting a clear technical pattern of any kind. It also seems to be struggling to get above the $1 resistance level. It's possible that it will see a pullback before moving higher on the news of the Sonic upgrade, which is expected in the next few weeks. And if you want to keep track of which cryptos are pumping and also where you can trade them, be sure to check out the Coin Bureau Telegram channel using the link in the description.
And that's all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive trading fee and hardware wallet discounts, as well as sign-up bonuses of up to $60,000 on some of the best exchanges, only for the viewers of this channel.
Also, if you want to pick up some snazzy crypto merch, the Coin Bureau merch store has it all.
You can find the link to those resources and many others in the description below.
Thank you so much for watching, and we'll see you all in next week's episode.